Santa Barbara Finance Committee meeting of January 27th, 2009. With me today are Councilmember Falcone and Councilmember Schneider. Today's agenda deals primarily with the December 31st investment report and the December 31st fiscal agent report. Mr. Pearson, please.
Thank you, Mr. Chair, members of the committee. Bob Pearson, Finance Director. And Mr. Chair, as you said, the item is the December 31 investment report, which, because it's a quarter-end report, also includes our fiscal agent investment report for the same date, December 31. As we all know, the final quarter of calendar year 2008 was a tumultuous quarter, including an unprecedented move by the Federal Reserve Bank to lower interest rates to virtually zero. Technically, I guess it's a band that they set between 0 and 0.25%, and so that's the first time I've seen that in this country. And so the credit markets, of course, have continued to be in significant disarray, and that was the environment within which we lived for the final quarter of the year. On the first page of the investment report, you can see we've actually provided you with a brief history of the Fed funds and discount rates going back to the Fed action on December 11th of 2007. And then you can see at the bottom of that table the December 16th of 2008 rate cut, which is the one I just spoke to, where the new level of the Fed funds rate is in a band between 0 and 0.25%, and the discount rate is at 0.5%. So that was really it. On page 2 of the report, we show you a history of the yields on U.S. Treasury obligations across the yield curve from a 3-month T-bill all the way out to the 30-year long-term bond. And we show that to you over a period of 4 quarters. And you can see that the cumulative change across the yield curve has been fairly remarkable, anywhere from a low of about a little less than 1% at the short end of the yield curve, all the way up to over 1.5% at the long end of the yield curve. And during that same period of time, LAIF, which, as you know, is our primary, the state of California's local agency investment fund, which is our primary money market management, short-term overnight money investment option, actually held up pretty well. It only declined about 0.4% from September through the quarter to December, ended the quarter at a 2.35%, which for overnight money is still a pretty admirable rate of return, considering that that's overnight money, and that the 2 to 3 year Treasury obligations that we might otherwise be looking at are at 1% or below. So that's a pretty good deal. The investment activity, you can see at the bottom of page 2, we did make 3 purchases. And one of those was a certificate of deposit that we renewed with Montecito Bank and Trust, and the other 2 were Federal Home Loan Bank at $2 million each, one of which was callable. We did have 2 securities called during the period, and we had $11 million in maturities. So the maturities and the calls greatly outweighed our purchases, and you'll see that when we look at some of the portfolio statistics. But essentially, we were not heavily in the market during the quarter because of the tumult in the market, that we just didn't feel it was the right time to be jumping in. The other thing...
Question specifically on that. First of all, I'd like to tell the folks who are watching that we don't have an overhead projector today, but all of these charts are available in the finance department or in the clerk's office, I'm sure. So it's not like you can't get the chart. You can. It's just that we don't have them available to be able to show it to you today. That being said, as far as, we're under certain obligations to only buy certain types of vehicles, and the question that I have is, you said we weren't in the market over this last period because of the volatility and tumultuousness. Are we allowed to sit on cash for a while? If so, how long? Because I think there's a time limit on that as well. There's a time limit of what kind of or there's a limit on what kind of vehicles we can buy in terms of treasuries and so forth, and no stocks and so forth. But we're also under some restraints about how long we sit on cash, and I'd love to sit on cash at this point. It's cash is king, and I'm just wondering what those parameters are, because we have to reinvest at some point.
Councilmember Falcone, indeed we do. I don't know of any legal restrictions that preclude us from holding cash as long as we want. A practical consideration is that there is a limit in state law to how much we can invest in LAIF. Every LAIF account has a $40 million limit. And so as a practical matter, we certainly don't like approaching that limit in LAIF, simply because once we approach the limit, our flexibility becomes narrowed. Our only other alternative in terms of hoarding cash, if you will, is to leave it in our bank account.
Money market account like the rest of us do.
That's correct, which clearly does not yield as much as LAIF does because it's tied to Treasury bills. And so that's really the only constraint that we face in terms of managing our cash, is where would we put it, given that the LAIF accounts have a $40 million cap.
Well, and just to be clear for folks, LAIF is the term we use is invest in LAIF, but really it's a daily liquidation. I mean,
Yes.
so it's just like a money market account. You can go and liquidate immediately on a 24-hour kind of, well, not a 24-hour.
It's actually less than that. If we call LAIF by 10 a.m. On any given business day morning, the money to draw money down, the money is in our account that same afternoon.
So it's like a money market account for folks who, are out there
Yes.
wondering, oh, they're investing. No, it's really like a money market account for governments that pays a little more than your money market account does.
That's absolutely right.
So do we have a policy at this point, or are we sort of taking the tack that we are going to be sitting on some cash for a while?
I think that there are some potential cash flow needs that we are looking at over the next quarter, which at this point lead me to want to be conservative in terms of making sure that we have enough cash on hand. We'll see how those potentialities play out over the next 60 to 90 days. And I would say that sooner or later, regardless of the interest rate levels in the bond market, we're going to have to get back in and buy, because eventually LAIF will continue, the yield on LAIF will continue to decline, and it just behooves us to maintain a fairly methodical pace of investing over time, regardless of the interest rates. But for now, because of our potential cash needs, that's really why we're sort of holding back.
Okay. Thank you, Mr. Chair.
Okay, thanks. Further questions on that? Great. Proceed, Bob.
Thank you. Just on the top of page 3, you see our summary of cash and investments, and we ended the September quarter with about a 4.47 yield. And a days to maturity on the portfolio of 578 days. By the end of the quarter, that yield on the entire portfolio had dropped from 4.47 to about 4.04%, and our days to maturity of the portfolio had shortened fairly considerably from 578 days to 471 days, about 3.5 or 4 month. Yeah, and so about a little over 3 month decline. Now that's attributable to two things. One is, if we don't do anything with the portfolio, it naturally becomes shorter over time as the pieces of paper that we hold move closer to maturity. The other is because we consider LAIF to be 1 day maturity, which it is. As our LAIF balances increase, that has a weighting effect which shortens the duration of the portfolio, regardless of what else we've done. The other thing that we wanted to point out to you is that during the quarter, two of our corporate notes were downgraded, and they were downgraded by Standard & Poor's. And one of them is Wells Fargo, which S&P, Standard & Poor's, initially put under negative credit watch in October, following Wells's acquisition of Wachovia Bank. On December 19th, S&P downgraded their ratings and outlooks of 12 major U.S. and European banks, including Wells Fargo. And so Wells Fargo corporate notes were downgraded by one notch from AA plus to AA. So they lost the plus. The last credit ratings change to Wells Fargo occurred in November of 06, so that and that was an upgrade when they gained the plus. So really, we're kind of back where they started from a couple years ago. Moody's has yet to downgrade them. As of December 31, we do hold $4 million in Wells Fargo notes, representing a little over 2% of the portfolio. The AA rating that Wells Fargo now holds pursuant to S&P's rating is still well within our credit limitations of what our investment policy allows us. We could still even buy them at AA, let alone see a downgrade in a piece that we are. There's really two different standards. One is what can you buy, and then another one is, well, after you've bought it, if it's downgraded to a certain point, we're obligated to sell it. But we could even still buy this at a AA rating. So while we're keeping an eye on it at this point, we're not overly concerned, although with the continuing trauma in the banking system, we are keeping an eye on it. So that was one of them. And the other one was the Toyota Motor Corporation under review for possible downgrade by Moody's. They had been the only automaker with AAA ratings from both S&P and Moody's, and because of the collapse in new auto sales, there is some concern over that. As of December 31, S&P still maintained their AAA ratings on Toyota. We hold $2 million, not of the motor company, of the car company, but of their credit corporation, their financing arm. It represents just slightly over 1% of the portfolio. Again, both of them are still well within our credit guidelines, but we did think it was important to advise you of those downgrades.
Question here, Bob.
I'm not sure if you know the answer to this, Bob, but in that there are a tremendous number of foreclosures in the housing market, have there been corresponding defaults and repossessions in the car market? And if so, is that affecting the credit arm of these car companies in a material way that you've been able to notice, that has been tracked? It seems like the same side of the same coin with a different vehicle, so to speak, no pun intended. So I'm wondering, have you seen any of that? 'Cause
Have not,
Okay.
actually. I don't.
I know repossessions for cars have been up. I've seen read a number of stories about that across the country. Now, whether or not it's affecting, Toyota specifically, but they're up.
Yeah, I don't know, honestly.
Okay.
I don't know.
Might take a look at
Yeah.
it and see.
I do
We
know.
don't want to wait for the downgrades to get out if it's
Right.
slipping along.
That's absolutely right, and
No.
that's why we normally, before a security or an issuer is downgraded, they are put on what's called negative credit watch, which is an actual official
Yeah,
classification.
then it's too late.
Yeah, it can be. The good news with these is that, for instance, the Toyota Motor Credit Corp is still AAA rated, so it would have to fall to below single A before we were obligated to
Okay,
sell it.
just
So
something to keep in mind.
It is
That's
indeed,
all.
and we do. I mean, it's a good point because we do keep an eye on these, and we have people that help us watch the brokers we use to buy securities that we do business with. They know what's in our portfolio. They know what they sold us. They know what else we have in our portfolio, even if they didn't sell it to us. And we're constantly getting emails on a daily basis.
Okay.
So we do keep a close eye on that.
Good. Thank you.
The last thing I want to cover briefly is page 2 of the actual investment report. It's titled Summary of Cash and Investments, and it shows, as always, the summary snapshot of the portfolio as of the prior month end, and then the same look as of the current month end. And the thing I wanted to point out to you, which I just been mentioning, was if you look at our life balance, at November 30th, we were at $33.2 million, but by December 31, we were at $48.6 million. Now, I know you will think, you were going to quick to tell me that I just said that there's a $40 million cap on a life account, and that's still absolutely true. What you see here on this report is a combination. We have two separate LAIF accounts, one for the redevelopment agency and one for the city. So we actually have $80 million of capacity. We don't commingle, however. So what you see here, commingle meaning we don't put city money into the RDA LAIF account. We do, yes, because this is a portfolio report, and so we do combine them.
So it's a consolidated number that we're looking at here, but the accounts are maintained separately.
That's correct. That's absolutely right. But you can see that there was a fairly substantial increase in the LAIF balance, which had a significant impact on shortening the days to maturity of the overall portfolio. So that was all I wanted to point out on that schedule. That concludes my report.
Any further questions or a motion?
Motion to accept the report and send it to council.
Moved and seconded. All those in favor, please say aye.
Aye.
Aye. Motion carries. Thank you.